Hello, this is Pro Guang from TaxClinicAccounting. This part is a segment of the financial statements consisting of two types of documents: the balance sheet, known as Daika Daijopyo in Korean, and the income statement, Sonig Gyesanseo in Korean. We ask for your understanding as we cannot explain every detail separately. At the very least, these documents are prepared twice a year, around June, marking 6 months into the year, and at the end of the year for tax reporting purposes. We always ensure that documents are generated so you can track the progress. We will share these through folder sharing so you can verify the contents. The first document is the balance sheet, which reflects the financial status. It's essentially an overview of your assets, and an income statement displays business performance or operational results. While you may not be able to see all the details on the balance sheet, it is crucial to look at the total amounts. It represents the total assets owned by your business, including cash, equipment, and inventory. We cannot instantly track cash in the bank. Hence, it might not match exactly. We request confirmation of the balance from the bank at year-end to reconcile the current cash amount. Principally, the total on the balance sheet covers the entirety of assets, cash, equipment, and inventory owned by the business. As businesses can have some debts, the total liabilities represent these total debts. In summary, the balance sheet records both the total assets owned and the debts incurred by the business. You can check the amounts. Further down, retained earnings represent the accumulated profits and losses since the business began operations. Although revenues might have been distributed at times, the remaining amount after such distributions or total losses since inception is reflected here. This should give you a basic understanding of the balance sheet. Next is the income statement. Regarding business operations, the total revenue comes first. Then, any directly related expenses, known as costs, follow. These are the costs associated with generating your total revenue. Additional operating expenses, such as rent, various fees, utilities, etc., are considered operational costs. By calculating the total revenue, costs, and operational expenses, the final profit or loss emerges. If a year has passed since using our service, the income statement allows for period comparisons. For instance, in this example, in fact, revenue increased by 25%, costs increased accordingly by about the same rate, operational expenses rose by about 5%, and ultimately, the profit increased by approximately 67%. This explanation covers crucial parts of the balance sheet and income statement. We generate and upload documents at least every 6 months, so you can check them in the financial statement folder and understand them based on this video. Also, when examining the income statement, keep an eye on significant changes. For instance, if a new cost arises or there's a sudden change, like 51% or 78%, identify those costs. For small amounts, an increase from $34 to $50 shows a 50% change statistically, but isn't substantial monetarily. However, if you observe costs like the third product's cost, rising from $1,500 to $3,200, a 105% increase, it demands attention. Logically, sales should have increased proportionately. In fact, the revenue for the third product has increased by 105%, matching the cost increase, indicating it is justified. This concludes the simplified explanation of interpreting the balance sheet and income statement. Please review the updates every 6 months. Thank you. This was Pro Guang from Tax Clinic Accounting.